That's rather, I know what I know. I'd much rather hear from you about what you're interested in knowing or learning. Okay, so we're going to talk about from a Wall Street point of view. The 3 points I want to make that I listened this morning to 5 hours, and there's a couple things Wall Street really disagree with, which is very typical. I'm a Wall Street analyst, so I sit outside the ecosystem and look at money trends, money flows. We project out money like revenues, and we discount it back to present value. I would say that there are a bunch of things that we're talking about on Wall Street that are not being talked about so far at this conference, so we're going to share some of those with you. And the things we sort of disagree with, the generative AI one is a really big one, which is, we heard from Activision this morning that they're using generative AI to help create content. What Wall Street cares about today, are you using generative AI to cut costs? We want costs down now, this quarter, next quarter. Generative AI is going to have implications for creator content and making content. We care about, let me call it, what are they calling it? Optimization, workflow optimization. That should be coming out of every CEO's mouth. And if it's not, that's bad. That's bad for your stock price. We care about using generative AI to cut costs right now. Another thing I heard, another thing that's really important is anything that's slow rolling doesn't work for Wall Street. I mean, forget generative AI, just generally. America is 4% of the global population and 25% of global GDP, okay? Europe is 50% bigger in population and half the GDP. So anything that acts like a CEO or a company is gonna wait and watch and learn, none of that works for us. We are into productivity. And then the last point I really wanna make that I feel is a difference is you cannot raise money today. Wall Street's public markets only, by the way. It's not venture capital, it's not private equity, it's not Series B. It is hard for any company to raise money unless you're in generative AI today. Why? There's a company that just came public called CoreWeave. In 2022, it was founded at $12 million of revenue. The next year, actual in 23, it did $300 million of revenue. The next year, actual in 24, it did $2 billion of revenue. And this year, estimated, and we're 3 months from the end of the year, $4 billion. So from 12, 300, 2 billion, 4 billion. Those kinds of companies can raise money, but if you're trying to get money for any other industry, nothing grows that fast. And in my world, if you miss, I don't manage money, I give advice, but professional money managers, 100% of them get paid to beat a benchmark. If you miss NVIDIA, you probably just got fired. If you miss this CoreWeave, you probably just got fired. So you have to be in these generative AI companies because they can hurt you. They can so overperform that if you're not in them, you actually lose your job. Whereas if you miss Disney or you miss Apple, it's gonna hurt you at the 10% level. Maybe it outperforms by 10%. You don't get fired over it probably. But these generative AI assets, we allocate assets for a living. Generative AI really can run away with you and hurt you both directions. But if it goes down and you own it, that's okay. The whole market went down. You didn't underperform your index. But if it runs away from you to the upside and you missed it, you lose your job. So I just wanted to say those 3 things because from a capital allocation point of view, those things are top of mind for us today. And I haven't heard maybe as much of them. The last thing I'll say is competitors. I think streaming executives for some reason seem to think they compete with Disney, Paramount, Warner Brothers. Wall Street doesn't believe that. Wall Street believes that who you compete with are YouTube and Amazon, that those are the entities to beat, and they never need to make money because they have a core business that's something else. So that's another thing I would say. The competitive set is not the Nielsen Gauge set of broadcasting, cable, streaming. With streamers, Wall Street's like, how do you beat YouTube? How do you beat Amazon? If Apple ever gets into the business, pray they don't, with $90 billion a year cash flow, that's scary. But I don't think we think of streaming as just the Nielsen Gauge pie chart. Okay, moving on, let's go. Okay, so this is something we're talking about a lot. Haven't heard it here yet, but this is one of the most interesting things I've heard, which is influencers on YouTube, big influencers, not little ones, big ones, are coming to fast channels. Amagi has a product now that an influencer can auto-schedule all of his content. As you guys know, a lot of influencers have a lot of their own IP. So Amagi, you just shove it all into Amagi's system. Amagi schedules it, so it's a nice linear feed. And what influencers are doing, creators, is they're taking $1 and $2 CPMs on mobile and desktop, and they're turning them into $8 CPMs on CTV and opening up their audience. They're not vertical screen, they're horizontal screen or however it's filmed. But the point is, they will be the next source of excess supply. From a money point of view, what matters, let me say it that way, from a money point of view, this will hold cost per thousand pricing CPMs down because we're going to get a whole new supply from creators that are perfectly happy with $6 CPMs and $8 CPMs because they have library content that's their own, and they're getting $1 and $2 CPMs over on their traditional platforms. So this is what happens next, I think. Let's go to premium ad format supply. So there's a shift. This is actually a really big deal, and it's bad for programmatic. So one of the things we're hearing on the CTV shift is there's a real pivot because there's excess supply of connected television, in part because of Netflix and Amazon, but in part because of these creators coming in at the low end in fast channels. What's happening is the big guys that have tech stacks are doing 3D ads, pause ads, like LG, Roku, Samsung are all doing this. Pause ads, overlays, picture-in-picture virtual placements cannot be sold programmatically. They have to be sold through direct sales, and they're getting nice big premiums on this. They really can get $23, $25, $27 CPMs on these, but they have to be done through direct sales. So that takes away the total addressable market from programmatic. Programmatic meaning trade desk programmatic, where it's just, you know, you're selling and bidding on a 30-second spot. Decisions programmatic. Okay, 3D ads, pause ads, you guys all know about this. Brands, so I think Wall Street really believes in interactivity. Even Netflix said on their call yesterday, Netflix is down 10% today on their earnings. I don't know if you guys know that, but anyway, one of the good things they said on the call is they're going to start making some of their shows, especially reality, more voting shows, more interactivity, and I think that is, I think we all think on Wall Street that sort of, you know, overlaying Twitch kinds of functionality with lean back video is the future of television. Anyway, Netflix is experimenting with that, and it increases your engagement. If somebody's interacting with your content, you can serve them an ad, and they're probably paying attention, so it gets a higher CPM. Okay, you guys probably all know all this, but anyway, is CTV moving to biddable programmatic? I'm going to go with no. However, almost everybody in the operating system will say yes. So I would say that PG and PMP are not biddable. Technically, I think they are. But the minute you have a sales force involved, to me, it's not really biddable, open auction programmatic the way Trade Desk and Magnite would do it. So, and that's what one of the things Wall Street spends a lot of time on. I covered 9 ad tech companies. So we care about the total addressable market from connected television available to all those ad tech stocks. I think this is happening slower, that PMP, and you know why? The reason is because if you make high-end content like TV shows and films, and you sell it based on content, it is differentiatable. The minute you sell it on audiences through Trade Desk is incented to find that audience for half the price on some crappy channel. So you've just commoditized yourself if, in fact, you go into a decision programmatic environment. So if you have premium content, you are not incented to go to a biddable programmatic environment. So that's really, so the shift, everything's going programmatic, meaning in the use of the word is automated, but it is not going programmatic in this idea of swapping, selling content, which is distinguishable, to selling audiences, which is commoditizable. And this year, and interestingly enough, Trade Desk is down 70% year to date, its stock, and Magnite has closed the gap to almost be at the same multiple. So there's a real sentiment shift on the part of Wall Street that the buy side is losing power compared to the sell side, meaning Magnite represents sellers and let's call it publishers. And so Wall Street's really had a big change of heart about the relative power position within the decision programmatic ecosystem this year. Streaming trends, FAST is 30% of total viewers, 7% of total viewers, up 30% this year. There's a lot of FAST channels, probably need some consolidation. And I think what happens next is where Gen AI can be, data's a problem. I think Wall Street is locked down on this notion that data is the new black. And let me slow that down because that's actually really important. So in all of streaming, let's talk about streaming, or we can talk about old media, whatever. We want at least 2 revenue streams. We want advertising and we want subscription. Why? Because all of money management, which is our field, is predicated on diversification. It says if you don't own 30 stocks, you are subject to stock-specific risk, which is extra risk, so that's dumb. So own at least 30 stocks, and then you have diversification. This happens with revenue streams too. So if you're 100% ad-driven, and you add $1 of ad revenue, I don't affect your multiple. Your multiple is still 5 times EBIT cash flow. If you add $1 of subscription revenue, I give you more value because it's a revenue diversification point. That next dollar is not worth the same if it's a new type of dollar, because my nightmare as a Wall Street investor is to open up a paper and say, ad blocking is coming to iOS, and suddenly 100% of the revenue of your ad-driven companies are at risk, and they're down 30% that day. So what Wall Street wants is revenue diversification. So you have almost every streamer now is both a subscription model and an ad model. What Wall Street wants next is we want e-commerce. And what I don't want is what Meta's doing, which it says, okay, we're going to let e-commerce bid and we're going to get higher CPMs for ad revenue. That's dumb, because they already have 100% ad revenue. What Wall Street wants is we want a share of the e-commerce sale, which is a different type of ad revenue. Then we'll mark your multiple up because you've diversified. You've given me a third revenue model. What Wall Street believes happens next is there should be a fourth for everyone, and that is selling your first-party data to LLMs, to the large language models. So today, we have Reddit is earning $60 million a year from each of Google Gemini and OpenAI ChatGPT, from each of them to sell that Reddit data every single year to the large language models. CuriosityStream, which is a streamer, doubled its revenue by selling its data, which it owns, because it owns all that IP, to large language models. Wall Street wants that to be the fourth revenue stream. And if you don't have 3 or 4 revenue streams, you will have a lower valuation multiple, which is the equivalent of a higher cost of capital, which is bad for you. You want a lower cost of capital. So what Wall Street wants, they want those are 4 separate revenue streams that lowers risk the most. So if I buy your stock, I'm willing to pay more, because even if the e-commerce revenue stream dries up or the subscription revenue dries up, it's okay, I got other revenue streams that will protect my investment. So owning data is really important to Wall Street because we want that to be the fourth revenue stream. But we also want everybody to have sort of interactive TV and commerce revenue as well. Okay. This is the data debate. So CTV pricing power depends on data quality. I believe that. Not only having your own data, but then being able to first-party control it. So Wall Street tends to like LG and Roku and guys that have first-party data screen-wide. Like, I like this, there's a girl at the head of Ignacio AI, and she says all data is valuable if it's good data with permission. So so what's going to happen with large language models, anybody who's used them knows they hallucinate. So the better your data, the more valuable it is, actually. So I just think, you know, Wall Street's really focused on third-party data. Unfortunately, we sort of think is going away. We think it's not that valuable. But we do really care about first-party permission data that's also, like, comes in constantly, which, you know, we are writing, we meaning me, I'm writing that somebody should buy Roku for its data and just shut down its streaming business. But, you know, Anthony doesn't like that, of course, but that's a CEO. But I think that their data, their proprietary nature of their data alone would give, so there's too many LLMs today. There's 5 or 6. 3 will survive, maybe 2. So if Gemini bought Roku and then didn't share the data with anybody else, it would be a winner, slam dunk, because it would have that Roku data forever. So of course it couldn't shut down the core business because that's where it gets its data. But I'm mostly just doing it to irritate the CEO. Okay, so streaming trends, you guys know about this. This is actually a really important trend. So performance CTV, so another reason that third-party data is under threat is that it is shocking to me how many problems we all hated Nielsen, but I wish for Nielsen again, right? So for many years I was an old media analyst, and Nielsen took 2% in the middle, and all of the guys that made content knew that Nielsen numbers sucked, and all the distribution guys like Comcast and Brighton knew it sucked, and no one cared. They did their core business, they gave Nielsen 2%, it was a currency, everyone just went around their day job. With all of the drama, with all of the data providers now, all they do is badmouth each other. It creates chaos. and it just uses a lot of the dialogue in the conversation, so people can't do their day job all the time, because they have to be thinking about, you know, what measurement currency they're using. Is it standardized? Is it, you know, comparable to the walled gardens or comparable? It's just a nightmare with all this data. So what's happening is the market, the commercial market, is solving the problem by tying the ad unit to an actual purchase, because then you don't need data. You know, I spent $100, I got $150 of sales, I'll spend the next $100. If I got $50 of sales, I'm not spending the next $100. So another reason that Wall Street is not at all interested really in third-party data is because this is happening, that people are just disintermediating data providers and saying, Amazon, I will buy an ad if you tell me what the incremental sales lift is. Mountain is another performance CTV for SMBs. They added 2,500 clients last quarter. So they are a performance-connected television, and so SMBs increases the total addressable market size. Instead of CTV just being large, it can now handle small. They're taking share from Facebook. Because what happens on Facebook, the Facebook average CPM is $33 in the US per thousand. So you can come to CTV and buy an $8 or $10 performance CTV CPM on Mountain, and you get a whole new audience. So why wouldn't you buy $10 ad units that are linked to sales all day long instead of buying a $33 ad unit on Facebook, and you're saturated, which is a mobile phone. So that's what they're taking share from Facebook, Instagram, and moving it to connected television, opening up the total addressable market for CTV. But I think Wall Street believes increasingly that we're going to get performance types of demands or metrics around connected television, and data providers will get squeezed going forward, I would say. Generative AI will make it all simpler to onboard small and medium businesses. So Gen AI, I would say 30%, that's wrong. I would say 50% of every conversation I have on Wall Street is what happens to media in the, you know, what's the impact of Gen AI, right? So let's be clear. The last disruption, okay, that's not true. The last big disruption, let's just say the internet. We're on the fourth disruption, let's be clear. So we went from mainframes to, in our lifetime, everyone in this room, in our lifetime, this is the fourth disruption. Mainframes, IBM mainframes went to PCs. Next thing that happened was the internet. Next thing that happened was mobile. Steve Jobs created apps in the iPhone. This is now generative AI. The big disruption of internet was distribution. We went from local broadcasters, got bigger to regional cable companies, got bigger to satellite companies, which are national, and now internet created global platforms. So the big winners are globally scaled media companies. I put Google, YouTube in media. I put Facebook, social in media. I put, okay, Amazon is a utility, not media. But the point is, and basically what happens is, if you are not global, you lose. Why? Because if I make a piece of content and Google, YouTube has the option to earn 10 cents from Germany and 5 cents from South Africa, I'm going to give them a lower cost of capital. I'm going to mark up their multiple of what I sell them at because they have optionality on pennies from places that ABC, CBS, and NBC don't because they're local, or Comcast doesn't because it's regional. So, okay, that means it's time for questions. I think I'm on my last slide, too. That's my 20-minute mark, and I wanted to give you guys 10 minutes for questions. Okay, yep, right on time. Okay, so I want to take questions. What do you guys care about that I haven't talked about? Yes, sir.
Hi, Greg Smith, Stream Vantage. Applaud your use of eMarketer, big fan of eMarketer. One of the slides there is about, or one of the charts you had was adoption of fast audiences. And one of the things I've been struck with is just how low that number is. It's like 35%, I think, that you had for 2025. And the growth rate is really not that significant moving forward. There's a whole bunch of other research entities out there that say fast adoption already today is like 50 to 60%.
What's the question?
So the question is basically, I'm just curious what your sense is. Do you actually agree with eMarketer that only about a third of U.S. households are actually watching FAST on a normal basis?
No.
Or?
So what we're getting is, I just told you, creators are coming to FAST. They bring with them their fandoms, and once their fandoms come to CTV, their fandoms move around, right? So actually we're going to get new sources of demand under 35 years old coming from YouTube, coming over to CTV. So they are good for CTV. What it does from a monetization, it's bad for the money people, for premium, because basically it blurs the edge of user-generated low quality over on YouTube, and because Trade Desk isn't going to tell you if you're buying a content creator or if you're buying Netflix, right? They're a decision based on audiences, so they're going to be over-delivering. So I think it's good for connected television. I think it's bad for premium from a money point of view, because I think they moved $8 and $10 CPMs into creators. I think FAST is going to be growing really fast. It's growing 30% now. So I think it will continue to grow. What else? Yes, ma'am.
So you mentioned near the beginning that if you are a streaming network, Wall Street cares how you're competing with Amazon or with YouTube. Where is Netflix in that equation? Is their operating margins just so outstanding that nobody can catch them anymore?
So I mean, I think the issue is, so good question. YouTube is a pure play, sorry, I apologize. Netflix is a pure play premium TV and film company. And it's necessary but not sufficient. Where everyone needs to get in the end is to bring a consumer to your platform and then hold on to them. What that means is I think every platform has to be in live, meaning news and sports, and produced, and short form, and long form. And generative AI is going to allow 3-minute, 10-minute, 15-minute video storytelling to be ever more impactful. My opinion is an aggregator needs to aggregate all of that. Netflix is slow, really slow. Games is taking them forever. Advertising is taking them forever. YouTube is fast. YouTube says, we're going to take 50% of the economics. You 2 million people go nuts. Whatever you want to do, we'll take half the economics. So they allow if you can build an audience, they'll let you do it. You can start a channel today. If you can build an audience, YouTube's there for you. So they adapt much faster because they put it on you to drive fandom. So that's where media is going. Media is, can you drive fandom? What Taylor Swift does, she sort of makes music, really? She drives fandom. She manages fandom. That's where media is going. Can you grab a fandom and hold on to it and then move it across platforms to maximize your money? That has nothing to do with top-down, can I tell an hour-and-a-half film story or a 40-minute, which is a real top-down, lack of community kind of feeling. So the old media tends to react much more slowly than platforms, I would say. Yeah. What else? Yes, ma'am. Hi, Holly. Jose's there with your mic.
On shoppable commerce. Can you go a little bit more into that? And also, I think at one point we were even talking about the fast channels getting into shoppable commerce, but where do they expect that to come from? And like you talk about Netflix, that's not there on their platform. Is there an expectation?
So what I like about shoppable commerce for fast channels is it gives them data. If you're selling something with a QR code, it would be a way to gather data on who's buying it. Let's say you do it at a discount. It's a way to have a subsidized data point from a fast channel that they have no other way of getting because Roku won't share the data. Or blah. So I like the idea because it gives them a data flow to make content better, but also it gives them, in theory, a revenue stream from whatever they just sold. So I like the effect. I like the idea of fast channels creating a second revenue stream in commerce. You know, we're doing QR codes. As you know, Holly, you've been in this business as long as me. How many times have we seen this shoppable television and it just doesn't work?
I think
and
I
right
was
now
pitched,
we're shopping on a second
in
screen.
1994,
Yeah,
95.
I mean it's failed like 3 times. You know, 5th time's the charm maybe. But the point is, people are shopping on their second screen. The TV shoppable is like, do you really want to use your remote? And Roku's trying to make that happen with Shopify. For sure, Amazon's trying to make that happen. So we'll see. It's just, it won't be us. It might be a 25-year-old who's just used to interactivity. I think it takes a user behavior change, and the tech is there, but it just takes a user behavior change, which has been taken decades longer than we thought, I think, to happen. What else? Anything else? Am I doing on time? I have 4 minutes. Yes, sir.
What are your thoughts on CPM rates? Are they trending up, down? Are they going to stay the same? What do you think?
They are down. They are down not only in premium because of Netflix and Amazon flooding the market in 2024 with all that new inventory, but now because of FAST. And it's just excess supply right now. And to the extent you sell on audiences, you are commoditizable. So to the extent, you know, Trade Desk and Magnite are in the marketplace, I would say CPMs are down below 8 right now. in the FAST marketplace, which I believe, by the way, this is a huge bone of contention. I believe that is a substitutable unit with the $30 CPM and therefore puts a price umbrella on the $30 CPM. There is a group of very vocal people on Wall Street that disagree with that and say premium is defendable, it sits behind its own like walled garden idea, and it can maintain $20 to $30 CPMs. And my attitude is CTV, and unless you can tie it to performance, they bleed together. They are substitutable at the margin. So I don't believe that, but it has not been decided yet. This is an ongoing vicious debate about the protectedness of the $20 and $30 CPM. Yes, sir?
The ads aren't skippable. Shouldn't that bring the value up? I mean, most people who are watching cable or broadcast are watching on their DVR and fast forwarding through the commercials, and that's not really an option for most users. They don't know how to do that when it's a streaming app or fast.
So does it make, so I don't think that makes the value of the ads higher. What makes the value of the ads higher is either tying it to purchase, which is an outcome, like a sales lift, because then I know I can bid more because I know that, I know exactly when I can stop bidding that unit up because I know what I'm selling. That's the highest value. That's probably a $35 CPM as long as you're selling $45 worth of merch. So that's the most valuable. The next most valuable is knowing what the audience is, knowing that these are women who cook with copper is going to get a $30 CPM, right? Even if you can't tie it to a purchase. The lowest form of CPM is where I'm reaching, like run of schedule, like the old media run of schedule, that is the lowest CPM, and a lot of fast is that because Roku doesn't share the data. So no, I would say more data tied to the ad unit is more valuable, and of course if it can be tied to any kind of performance metric, test drives, site visits, website visits, actual purchases are the most valuable, and more competitors are going to move towards sales lift because that's now by the way, it's not brand building. It's pivoting all of America towards the bottom of funnel this quarter action. So you really raises the question, not my purview. Do we ever have brand building? Does anybody buying a Mercedes in 20 years because there's no brand building anymore? I think good question, not my problem. Somebody else's problem. What else? Yes, sir. Oops, sorry, whatever.
So you've covered the legacy side of the business for a while. I know it's not your purview today, but
Yep.
I am curious, given what you're focused on today and your need for 4 different revenue streams,
Yep.
How does news survive in this new economy?
So curating fandoms is my sort of go-to. So a news guy's got to figure out his fandom that he's speaking to. So he's probably got to be on social platforms. He's probably got to be, he's got to be everywhere where a consumer is, and he's got to care about 25-year-olds. So you better make it funny, or you better make it engaging. And a lot of people like politics, and a lot of people don't. So that means you've got to find your niche and then move it across platforms, from cell phones to desktop to CTV, create all those revenue streams. That's how. It's about curating fandom. Yes, sir.
Two-part question. You mentioned the Nielsen Gauge report. If you look over the last 2 years, there seems to be a fundamental shift. Streaming went from 40 to 50%. Broadcast cable went from 50 to 40. So one would assume it shifted to streaming, which is, if you comment on that.
Question.
And given that, do you agree with that shift?
Don't care. Care
Don't
about the
care.
money.
Okay, you don't care, but then you go
Don't care.
to Paramount bidding.
Because you're ignoring demos. Even if it had stayed the same at 30%, if they're all over 60, I don't care. They're not monetizable.
Okay, I get it. But now you look at Paramount bidding for Warner, or proposing maybe. Both are linear broadcast, cable-driven companies, over 80% of their EBITDA. Why is Wall Street then valuing Warner Brothers at an 80% premium versus stock price before that bid was announced? Why do you
Has
think?
nothing to do with value. I think Warner Brothers is worth $15 a share. This is 2 billionaires. Larry Ellison made more in 1 week, 3 weeks ago, than all of Warner Brothers would cost to buy, and there's only one. If you don't buy Warner Brothers now, it doesn't come available. There's 3 of them. So Larry Ellison is a billionaire. with a vision. The guy's going to die and leave all his money to his kids. He's just transferring money to them earlier. And if it's $100 billion, so that's a billionaire. And David Zaslav is a world-class negotiator, I think, unless he overplays his hand and everybody walks away and then his stock's going back to 15. So, you know, I would say this has nothing to do with value. This has to do with gamesmanship. You know, what are those people on horses with the long jousting? That's what we're doing here. You know, billionaires, a fight among billionaires having nothing to do with fundamental value, in my opinion. Okay, I have to leave. Sorry. Can I take Alan? Oh.
There's more. So in the last 10 minutes, I've heard you say like 3 times, Roku doesn't share data or something to that effect. Do you think there's, and this is a constant thing I hear from both publishers and advertisers, that they're, you know, why they don't like this particular market. Do you think there's a path? I mean, I know why Roku doesn't do it. Do you
What's the
think,
question, Alan?
is there a path for somebody to actually share data, to start being more transparent about data? And is that a viable thing? And can they do it and run?
One of the things that's always been true in media is data has value. So the more data you have, then when you come up for renegotiation on the license, you get a better deal, and you just let the stuff that's shitty that they don't know about lapse. So there's always been a data advantage. Comcast had certain kinds of data, Netflix, you know. So there's always been a data advantage in data asymmetry. So Roku, for its own economics, is absolutely not incented to share data and put other people on an equal footing. So no, I see no economic reason Roku should be incented to share data, even with the NFL. The NFL says they don't share it.
Could somebody do an end run around them and say, hey, we are going to share data, and then take market away because people are like,
But they have a 94 million TV household installed base. How do you, it's like trying to end run iOS. Once it's in the consumer's home, it's a problem. Yeah, well, you know, America loves America. Anyway, that's it. I'm running. Thanks. Bye.